A. Negotiate and manage syndicated agreements. Syndicated loan agreements are important financing arrangements used by organizations to obtain large amounts of capital from multiple lenders under a single coordinated structure. Treasury professionals negotiate syndicated facilities when funding requirements exceed the capacity or risk tolerance of an individual financial institution. These agreements are commonly used to support acquisitions, capital expenditures, refinancing activities, working capital needs, and long-term strategic initiatives. A lead bank, often called the arranger or administrative agent, coordinates the transaction, negotiates terms, and manages communication among participating lenders. Treasury professionals evaluate market conditions, interest rate environments, organizational credit quality, and funding objectives before entering negotiations. Effective management of syndicated agreements improves liquidity access, financing flexibility, and long-term banking relationships while supporting strategic financial objectives. Negotiating syndicated agreements requires Treasury professionals to evaluate multiple financing terms and align them with the organization's operational and financial strategies. Key negotiation areas include loan pricing, interest rate structures, maturity dates, repayment schedules, collateral requirements, covenant restrictions, and commitment fees. Treasury teams seek to minimize borrowing costs while maintaining adequate flexibility to support future growth and changing business conditions. Financial covenants, such as leverage ratios, interest coverage requirements, and liquidity thresholds are especially important because covenant violations can trigger penalties or loan acceleration. Treasury professionals must carefully analyze proposed terms to ensure the organization can comply under varying economic scenarios. Successful negotiation requires strong communication, financial analysis, and relationship management skills when working with banks, legal advisors, and internal stakeholders. Syndicated credit facilities may include revolving credit agreements, term loans, bridge financing arrangements, and multi-currency borrowing options depending on organizational needs. Revolving credit facilities provide flexible access to short-term liquidity and are commonly used for working capital management and seasonal funding requirements. Term loans provide longer-term financing with scheduled repayment structures, while bridge loans temporarily finance transactions until permanent financing becomes available. Treasury professionals evaluate the advantages and risks associated with each facility type, including refinancing risk, interest rate exposure, and foreign exchange considerations. Multi-currency syndicated facilities are particularly important for multinational corporations because they support cross-border funding and operational flexibility. Effective facility selection strengthens liquidity management and supports efficient capital structure planning. Managing syndicated agreements after execution is an ongoing Treasury responsibility that requires continuous monitoring, reporting, and lender communication. Treasury professionals track covenant compliance, borrowing availability, repayment obligations, interest payments, and financial reporting requirements throughout the life of the agreement. Treasury teams also coordinate amendments, renewals, waivers, and refinancing activities as organizational funding needs evolve. Maintaining transparent communication with lenders is essential because strong banking relationships improve financing flexibility and future market access. Treasury management systems and financial reporting platforms support monitoring activities by providing visibility into debt balances, covenant calculations, and payment schedules. Strong internal controls and governance processes help ensure compliance with contractual obligations and reduce operational or reputational risks associated with debt management activities. From a CTP examination perspective, candidates must understand both the structure and operational management of syndicated loan agreements. Exam questions frequently assess the ability to analyze financing alternatives, interpret covenant requirements, evaluate borrowing costs, and identify risks associated with syndicated facilities. Candidates should understand the roles of arrangers, administrative agents, participating banks, and borrowers within syndicated transactions. Knowledge of revolving facilities, term loans, multi-currency arrangements, interest rate considerations, and covenant monitoring is also essential. Treasury professionals must recognize how syndicated agreements support liquidity management, capital structure objectives, and strategic financing needs. Mastery of these concepts enables Treasury professionals to negotiate effective financing arrangements, maintain lender confidence, and support long-term organizational financial stability.